Hello and welcome to Building the Premier Accounting Firm. This is a podcast dedicated to helping you as owners of bookkeeping, accounting, and tax businesses work on your business. Most importantly, address those things that need your attention so that you can build what I refer to as the premier accounting firm in your area. Each and every week we have on the show experts, individuals to help us address various things that are relevant to our companies, ranging from marketing, selling, offering quality accounting services, working efficiently and profitably. These are the things that matter most as we're actually working to offer quality accounting services and get paid what we're worth. Now, today's conversation is going to be something you're definitely want to pull out a notepad and paper for. Why? Because we're going to take some time to dive into your business and what it is you can be doing to work on your company from an exit strategy point of view. I've got on the show today as my guest, Len Bruskiewitz. He happens to be a business coach and certified exit planning advisor, which means that he helps business owners plan and execute a successful transition of their company to a family member, a third party, or employees on their own timeline and in their own terms. So, Len, welcome to the show.
Thank you, Roger. It's great to be here. Really appreciate the invite.
Yeah, this is going to be a very good discussion because I think there's two components to this, and we were discussing it earlier. Clearly, as accounting professionals, this is something that we can have a direct involvement with our clients doing. This is something that we can assist them as they're building their companies, and we're in that role of an accounting professional assisting them. But at the same time, we're running our own business, and this should also be something at the forefront of our own minds as it relates to our own companies. So there's a lot to dive into here. Let's first of all just kind of take this more from a broad point of view. I'm interested in knowing how you got into this role as a business coach and advisor, working with companies to actually sell them. What got you into this position?
Well, I had a long career in high tech, working on partnerships for all companies that focused on small businesses as their customers. So I had a long career at Intuit, at Constant Contact, at Grasshopper, all names you should probably recognize
Oh, yeah.
in the small business space. I actually ran the Intuit Professional Advisors program for a while, so
Very nice.
familiar with the category. And I decided to leave corporate a couple of years ago, and I had done a lot of coaching and mentoring, both of employees that worked for me as well as partners I worked with. And so I really enjoyed that. So I started as a general business coach. And what got me into this space specifically was one of my first clients, who was a 72-year-old woman who had started her business with her husband over 50 years ago, run a really successful business. Unfortunately, he passed away, and she was left just not knowing what to do. And she said, "Len, I can't sleep at night because I don't know what's going to happen to the business." So we worked through the options. She picked a course, made her decisions, moved on, and said, "Len, I can sleep now." And I said, I think I found my why. And so that's how I got into this specific niche of helping business owners get ready to transition.
I like that story, not only the background, but the specific story that you shared, because like you, I've seen that play out numerous times. You've got an example of somebody that with their spouse starts a business 50 years later, they're still unclear as how they're going to exit this business. One of them passes and still they're unclear how they're going to exit from this business. It's finally working with you that they're able to realize what are some of the options and get some clarity. And now it makes sense. Now they're able to sleep at night. And it just amazes me how many individuals are like them. They're starting a business, doing so well. This is how they're providing for their family. They're having fun. They're going through the struggles, pushing through everything. But to what end? They're just not clear as to how that's going to play out in the end. So I'm grateful that we're having this conversation because I think so many can relate to it. So the question I want to ask now is, what role does accounting or accounting professionals have as they work with their clients, preparing them to exit?
Accountants have a huge role in preparing businesses to transition. I could go into a ton of detail, but I'll start with one of the big reasons that companies don't end up transitioning successfully is because of poor accounting and poor process. So it is literally the number one reason that companies fail to sell is because they just have bad accounting, bad record keeping, and bad process. So incredibly important for the accounting professions to be involved in the process and involved early. I talk about, at least 2 to 3 years in advance of when they want to transition, they need to start the process. And that's, as you know, you can't make bad things in accounting go away overnight, right?
No.
If there are issues, it takes some time to work through those. So Accountants, bookkeepers, tax people are hugely important in the exit planning process.
One of the things that comes up as I work with my own clients and address this issue is there's typically a business strategy to say, what can we do to mitigate our tax liability? And so for so many years, they're working to pay as little as they can, which by definition implies they're not profitable. What can we do to just make it so that we're a break-even business? But when you're getting to that point of exit and you're trying to show that the company is making money and does create profit, all of a sudden that challenge is, well, you mean I have to pay taxes and I have to show I'm a profitable business? There is a mindset that happens there that's so different. And yeah, I think each of these come from the accounting profession. The accounting profession is so good at saying to the business owner, oh, no, we've got strategies that we can use to mitigate your tax liability, and let's do this. And it looks so wonderful, and they experience it for so long. But then when the strategy comes to how do I actually sell my business and get out of it my retirement that I was hoping to have? Well, I guess we need to change our strategy. We've got to actually now show that this is a profitable business and it makes money, and it actually is that goose laying the golden egg. So could you talk about how that transition happens in the accounting process, and more importantly, the differing strategies between the two?
I'd be glad to. The good news is it doesn't really need to change. So I agree with you that from a tax perspective, the goal of the strategy is typically always to minimize taxes, so to show very little profit. However, when it comes time to value a company, a third party who's looking at buying an existing business is going to look not so much at the tax return. It's kind of irrelevant to them. What they really look at is EBITDA, right? Earnings before interest, taxes, depreciation, amortization, as well as other add backs. So
Yep.
I'm not gonna lecture anybody in this uh, venue about EBITDA, but what is added back is typically things that are things that would go away or come back if when the business was sold. So that might be the owner's salary. That might be any personal perks that the business owner was running through the company. Potentially, maybe either an under market or an over market rental rate. Those adjustments would be made. And again, that doesn't need to impact the tax return. These are really kind of, they're not off books, but they are adjustments made to the actual earnings of the company for valuation purposes. Because really what ends up happening in valuation is it's that EBITDA, adjusted EBITDA times a multiple. So being able to show high EBITDA, even if you're not showing a high profit on tax return, is actually a great thing.
Perfect explanation. I like that because it is true. What you're doing is doing those add backs, and you're just basically trying to say, okay, here's what could change at the point of the transaction, simply because you're not going to be perhaps paying the next person running the business as much as the current owner is. And some of the benefits that they're deriving from the business aren't necessarily going to follow the business after the transition. So I like this. One of the things that I want to dive into, though, is you speak of 5 top reasons why business owners need to create an exit strategy, but typically don't. What are those things that you typically find hold up business owners from really addressing this exit strategy?
Yeah, so some of these are tough, but these are what they are. So the first one is really that there's kind of a lack of awareness and understanding of how important exit planning is. I think business owners just assume, that's really not a big deal and I don't need to think about it. So just, there are tax implications, there are valuation implications, there are people implications to, not having an exit strategy. So that's one, is really just that layer, lack of understanding of how important it is. The second is that there's really kind of an overconfidence in how the business will continue. So the business continuity. If I made this much last year, I'll always make that much. Doesn't necessarily work that way, right? It could be it worked. You had a great year for something that's non-repeatable.
Yeah.
But if you don't understand that, that can say, well, I don't need to do this, right? The third one, which to me is really the one of the biggest issues, is the emotional attachment of the business owner to the business. Uh, Business dependency on the owner is another way to think about it. And
Yeah.
business owners who've blood, sweat, and tears for 20 years don't want to think about not running the business anymore. This is a huge issue, and a huge issue as to why businesses don't end up selling. The fourth one is an uncomfortable one. It's facing the financial reality. So one of the first things I do with clients is do a business valuation, a full-on business valuation. Say, this is how much it's worth today. And I got to say, 99% of the time, the business owner thinks it's here, and the market says it's here, right? So
Yes.
you've got a big gap between the perception and reality, and that's really hard for business owners to take because, again, this has been their baby, and they think it's worth more, and so that's tough, right? So I think business owners don't necessarily want to face that reality.
Hmm.
And the fifth reason is that they think it's complex, right? And to be honest with you, it kind of is. There are, you have to get a new set of people involved. You may need a new accountant, right? The person you're using may not really be great at the next level that you want to get to. You may need lawyers and wealth planners and life coaches or whoever uh, to make that transition. The good news is you don't need them all at once, right? So you can ease into this. And these experts do this all the time, right? This is my job. Whereas most business owners go through an exit strategy once, to be
Yeah.
honest with you, right? So those are a handful of reasons why people put it off. And the scary thing is, in the U.S., probably 60% of business owners don't have a written transition plan. So it's not a little problem.
No, what you're describing here is, I think, very relevant and, more importantly, something I experience on a regular basis, because as I work with my clients, I also see that they don't have something formal, at least a game plan as to how they're going to transition out of this. And I'm just going to add to what it was you're sharing, because the first thing that I first of all realize is many of these business owners do see themselves as invincible, in the sense that this is just always going to go as it's always gone. And they don't realize their own mortality in this. And so exit planning, whether they're in their 30s, 40s, 50s, it's just, they just can't see that far out in the future as to say how this is going to unravel. And so that's one of the things that typically causes them to kind of just put it off. It's just not my priority today, and it's not something I'm going to worry about now. When in reality, it is, just like everyone should be planning for retirement, a good question to be asking. The second thing that I would add is the fact that a lot of the business owners, they just don't see their business as an asset in reality. At the end of the day, they just see it as an income. And too often what they're just doing is working a job. They don't see that somebody else may actually have, see value in this, and that they'd be willing to pay for it. And so they don't build something that they think anyone else would actually pay to have. And I make it akin to a house, a home, a house. All of a sudden, what happens is this house that you've built, yeah, it does have value. Somebody else could actually see themselves living there. And clearly it's a home to you, but more importantly, it's a structure, it's an asset. It's something that if you built it to code and you put in the right amenities, somebody else may see value in it, and at some point might be willing to buy it from you. But if you don't build it the right way to code, and you don't put in a nice kitchen, you have an outhouse. Well, nobody wants an outhouse anymore. So why are you building it this particular way? Well, it's how I like to do it. Well, the way you like to do it isn't amiable to somebody else. So if you start to build a company with the intentions of one day somebody else will be running it, all of a sudden you start to make different investments in the business, technology, staff, employees. All these things start to take shape simply because of the fact that you now see the business no longer as a job, but now it's an asset, and you're building something with that exit in mind. And then the third thing I would add to this whole process is the unknown. It's like this woman that you were sharing that had their spouse pass away. There's a lot of things that you can do that plan in the future for, hey, wouldn't it be nice? But nothing really turns out best case scenario. And so what happens is you need to build your business as if in the next coming months or year, the transition could have to happen because health changes, spousal situations occur. You've got unfortunate things related to divorce and so forth. These things necessitate an urgent transition. Well, when you're in that position, you're not going to get the most out of your business because it's a fire sale. And so what we're trying to do is say, why don't we build the business so that if and when it's ever necessary, it's ready to transition. And it's kind of like that house. If you're ready to move out at a moment's notice, it makes it a lot easier than, well, I've got to fix the deck, and I've got to fix the pool, and I've got to fix the driveway, and I've got to fix the landscaping. Well, no. It's all good, and it's ready to go today. So I appreciate how you shared those 5 things, because they're very, very relevant to what people experience, I think, in a reality situation. So very good. Get your free copy of the book In the Black, 9 Principles to Make Your Business Profitable. This is a how-to guide for accounting professionals to work with their clients and actually implement proven processes and systems to ensure that their clients make profit a priority. It is in this book you'll actually learn how to map the business and, in fact, make marketing, accounting, and production a priority within your client's business. You also learn the wisdom pyramid, how to actually take the information you're providing to your clients and effectively use it so that they can make more informed business decisions. This book is designed to help you communicate more effectively with your clients and, in fact, have them see you as their profit and growth expert. Get your free copy now of the ebook today. I'm curious, what would you say contributes to the greatest valuation of a business? What are some of those contributing factors that are not risks, but rather assets to the valuation?
Yeah, I'll start in terms of talking about valuation, about what third parties who potential buyers care about and what
Hmm.
they don't really care about, and
Please.
then how that valuation comes about. So the first stat I'll share with you is that only about 20% of the value of a company is based on the things you can see from the outside. How the industry, what are the growth trends, things like that. That's about 20%, or 1/5 of the value is based on kind of externally facing factors.
Okay.
Fully 80% of the value is really on internal items. And there are things like, we call them the four C's. So they're different kinds of capital, or intangible assets, as you'd call them in accounting, right? So it's things like customer capital. Do you have, is all of your revenue tied up in only a small number of customers who could go away tomorrow? Or do you have long term arrangements with customers across a broad range? So, what's the, how are your, what does your customer base look like, right? Do you have recurring revenue, or is it one time? Right? So that's one. You also have the kind of cultural capital. So what's the vibe of your company? Is it a place where people want to be working, or do they dread it? Right. That's a huge piece. There's also the piece that is directly related to accounting and bookkeeping industry, which is the kind of capital around your process, your record keeping. Um, can somebody else come in and run the business or not? Right. And that means, do you have SOPs that are documented? Right.
Hmm.
Do you have accounting practices that are documented and followed? So those are the things, those kind of intangible things are really what drive the vast majority of the business. It's not it's not those things that kind of look bright and shiny from the outside. So does that help? Just kind of giving you, telling you where the value really lives.
It does. And I'll add to it basically three things. And these three things I think are the paramount things. There's definitely some underlying things that we don't want to neglect, but these three things, when understood and implemented correctly, I think are really huge to the success of the valuation of the business. One is the client list. How stable are the clients that you have? And we distinguish, in my mind, between customers and clients. And so with the clients, we want to have recurring relationships where we're doing, let's say, the monthly accounting, and it's a subscription type process where we've got the recurring revenue. So that's one of the things that we want to look at: the size of the the size of the clients, the continuity of how long they've been a client. So somebody that's been a client for 5 years is much more valuable or likely to stay on with the business than somebody that just came on in the last 6 months. And so there's different ways to take that client list and give it value. And so what we want to do is just look at long-term clients, and the value is, how much they're paying and how recurring the relationship is. So the client list. The second, like you were mentioning, it's that culture. It's the staff that you have internally, that when the business is sold and there is this transition that happens where the owner may leave, how likely is it that they're going to stay on? How key are those employees to the success of the business model, and how are we going to retain them? And then the third would be, like you were pointing out, is processes. What systems do you have in place to ensure that the quality of work upon the departure of the owner is going to continue continue as it's been delivered to the clients already. What assurity do we have that the processes are documented, as you said, and that they're duplicatable? And if we're able to actually have confidence in those SOPs, then we're quite confident that we'll retain the clients, the book of business that we're perhaps acquiring, the employees. We don't have to worry about turnover and training, but also the system works. It's something that is automated. It's duplicatable. It's a process that churns out good quality work. That right there creates for an accounting firm a very viable business model. And so that's something that has great value and will increase the valuation of the business as it relates to the multiple that you might be using for the client. Now, with regards to accounting firms, have you been involved in selling firms as well?
Not specifically accounting firms. So,
Okay,
but they have similarities to businesses that I'm familiar with.
good.
As you said, there's this combination of recurring revenue plus one time or one off,
Hmm.
and what they tend to have is a pretty easy to understand structure, easy to understand the document processes. But what's beautiful about the accounting space is there is a recurring revenue stream to it. In terms of valuation, that is gold, to be honest
Yeah.
with you, right?
Oh,
If you've got to go out and get every new sale individually, that's tough to replicate, right? Whereas having a recurring stream, and even on the tax side, if you have people that are coming back every year, uh, that's a revenue stream that you can predict much more so than one-off sales. So
exactly. No.
it has a lot of the attributes that lead to great valuations because of the recurring rate nature, and it's typically there isn't one customer that makes or one client that makes or breaks an accounting firm. It tends to be distributed across a range of clients.
Exactly.
Also, a positive.
Yeah, one of the values that really come to the accounting profession is one, it's a great business to start. It's easy. There's no overhead. There's no inventory, all those types of things, high demand, great pay. But at the end of the spectrum, it's also a great business to sell because you've got the recurring revenue that typically comes from the clients that you're servicing. You've got typically standard operating procedures because you're doing the same work month after month, year after year. And so on the front end, it's a great business to start. And on the back end, it's a great business to sell. So it's got a lot of pluses for it. So let's talk about pitfalls. What are some of the pitfalls that business owners face as they're getting ready to exit and perhaps may affect the valuation of their business?
Yeah, I think some of the pitfalls we've touched on a little bit, but let me give you a handful of reasons why businesses don't end up selling. Um, One of the ones is just a misalignment of value, right? So companies that are there, let me just say that there are lots of businesses for sale. Only about 20 or 25% of them actually sell, which is kind of a disturbing stat. And one of the big reasons is this kind of misalignment between the parties. So companies that are looking to acquire businesses, accounting practices, for example, want the elite ones, right? They want the best accounting firms out there. There aren't that many elite companies in any segment. So what you end up having is a lot of average companies, and that just doesn't. Nobody gets excited about average, right? So what that yields is this misalignment of valuation, right? You know, you may be at the country club, and the accountant you play golf with says, "Oh, I sold mine for a multiple of 8, so I think I should get 8." Well, he or she was exceptional. You're not, so you're not going to get that value. So that's the
Yeah.
first one. The second one is, yeah, hopefully this is not an issue in the accounting space, but it's poor record keeping, right? Poor accounting records. That
Oh, it
yields
still
lots
happens
of
in
deals.
accounting. Don't fool yourself.
I'm hoping not.
It's the cobbler's story.
It could very much be. So that is absolutely one that means businesses don't sell. The third one is one I've talked about before, and that is if every deal, if every client, if every decision has to run through the owner, that business is unsaleable, right? So if everything is up here in the business owner's head, and if the business owner can't take a vacation, that's an unsaleable business. So it's really about getting that independence for the owner from the business. But that's a big reason sales don't happen. And then the final one is similar to the poor accounting. It's lack of documentation. If somebody can't come in and run the business once the owner is gone, again, either unsaleable or will sell for a very low multiple, because now the new owner has to come in and figure out what's going on. And I have just a quick story for you.
Please.
The case study I told you, the client I told you about earlier was a happy story, right?
Yeah.
I have the complete opposite. This is not a client of mine, as you be able to tell from the story, but it's the father of a friend who ran a very successful sole practitioner law office for about 15 years here in Boston, and it was just him and a bookkeeper. He ended up getting ill and dying, and had no exit plan. The family didn't even have passwords to his systems, so they couldn't get in. Turns out he hadn't filed tax returns for a few years.
Oh
Uh,
my.
the, the family had no idea what he was owed. They had no idea what he owed other people. And so they had to bring in forensic accountants. They had to bring in some forensic law practices. Cost them over $75,000 just to get things figured out.
Yeah.
Uh, and as you might have guessed, the business was literally worthless. And much like accounting firms, there is recurring business in the law space, right? There are recurring retainer clients that all just went away. And so not only did it cost the family the $75,000 out of pocket, but they literally got $0 from the business, which was planned to be a part of the legacy. So I dislike telling that story, but it does show kind of the trauma that can happen if you don't do exit planning. And the key to me, and this story is a great example. It wasn't just him that was impacted. It was his family, it was his clients, it was his vendors, and it was his community, because he was an important part of the community. Think about the accounting practices. You're the ones that are, you know, contributing to the high school, debate team or accounting club, or you're paying for a float in the parade, right? You're a part of that community, and that goes away if you don't have this plan in place that somebody else can take it over.
Well, I appreciate you bringing up the story because it does illustrate some of the unfortunate things that can happen when a business isn't treated as a business. And so often the accounting firms that I work with, many of them are solopreneurs. And so they are kind of in this situation. And the way I choose to explain it to them is, yes, you own a company and you are running a business and you have clients. And I applaud you for all of that. But at the end of the day, you've got a job. If you don't do it, it's not going to get done. You have a job in the sense that if it's not something that can be given to someone else, it's all dependent upon you. And so the valuation of that business is very much diminished simply because of the fact that you are the company. So all of a sudden, at the end of the day, what we're trying to do is help them realize, what can you do to extract yourself from the day-to-day operations of the business through either systems where you can delegate and duplicate yourself, or is it maybe it's at the point where you're trying to put in systems that automate various things. Regardless, what we're trying to do is take the business owner from that job situation to a lifestyle. They're now living what they're espousing to everyone they meet with. They own a business. Well, what does that afford them? Well, it should have freedoms and so forth associated with the fact that they're running a company. Well, now that they have key employees and they're taking care of the clients and there's systems that are being followed, now we've got a business that, in the absence of the business owner, it does still sustain itself. And so to quote myself, I'm always speaking of building a business that is self-sustaining, a living, breathing entity that can operate apart from the business owner. You build that, you've got something that has value that somebody else is willing to pay for, that somebody else can step in and run. And that's what we're trying to ultimately build. And it would avoid what you were just describing, because I'm clear in my mind that $75,000 that they spent for that forensic team to come in and try and open up this chest was all with the hope that they felt that there was something of greater value in the chest worth getting into and accessing. But at the end of the day, there wasn't. It was a false hope. They opened up that chest and there was nothing in it that was going to, compensate for that $75,000 investment. So lots of good things there. You've shared now 2 stories. I'd like to ask one more thing. What have you noticed of business owners who have a good transition? They do sell the business, but they don't have any purpose or something to drive them after the fact, in the sense that they've sold the company. They probably did have a good exit, but at the end of the day, so much of who they were was defined by the business that they owned and operated. How do you talk about the after the sale effects of being a business owner?
Yeah, I think about the after the sale well before the sale is,
Hmm.
is the short answer.
Yes.
So one of the first things when I start working with a client is do that business valuation that I talked about earlier.
Hmm.
But another thing I talk to them about is, what are you going to do next?
Yep.
What is your after business plan? And look, that may be retirement, that may be starting something new, it may be whatever. But it gets to the point that you and I have both said that you want it to be ready at any point, so it's on the business owner's timeline and terms. Um, but back to the question, it is something I spend a fair bit of time on, and sometimes it exceeds my capabilities. Right, there are times when I really say you need to talk to a life coach or a transformational coach, because one of the first things that a potential buyer is going to ask of a accounting firm owner is, what are you going to do next?
Hmm.
And if they say, I don't know, that potential buyer is heading for the exits, right? And there are good answers and there are bad answers to the question. I'll start with the bad. A bad answer is, I'm going to travel and play golf. Not a good answer, right? You can only play so much golf. You can only travel so much. What's a good answer? Hey, you know, my grandkids live in Kansas City. My plan is, my spouse and I are going to move to Kansas City. I'm going to work for a nonprofit. This is, what I'm going to do there, and that's a good plan, right? So, having a well thought out plan is absolutely crucial. It adds to the value of the company to be able to say that. But I also want to talk about one other piece,
Please.
um, which is, uh, you talked about it in terms of, how does it impact them.
Hmm.
The beauty of doing exit planning well is it's not just impacting a point in the future. A lot of times, what can happen, because a piece of the exit planning process is really looking at your practice and saying, what are we really, really good at, and what's really, really profitable, and what's not so much. And maybe it's time to get rid of that not so much piece of the business. And what can end up happening, and this to me is a good result, what can end up happening is the business owner sheds the pieces that they either weren't profitable, they didn't enjoy. And what they find is, A, they have more time, and B, they actually enjoy running the business a lot more than they used to. So maybe they put off that exit for a few more years.
Hmm.
That's a great solution in my opinion, right? Because they've been able to now focus on the right stuff and got rid of the things that didn't fit. They made their business more valuable, and now they can take a vacation and not worry, right? So to answer it's a long answer to the question, but it really is, postponing your exit is not necessarily a bad thing, as long as you now enjoy running your practice again.
Yeah, what I'll add to that is that when you have a business owner, which I've experienced, come in and say that they're frustrated, I'm done, I'm tired, I'm exhausted, I just want to sell the business and be done with it. The problem is it's not as sellable as they'd like, because they have this idea in their mind of how much sweat equity they've put into the company and what they've built over the years, that they need an X multiple in order to retire. And you tell them, no, it's not clearly worth what you're thinking it is, because of the very problems that you're saying are frustrating you. So let's postpone selling it, work on these things, so that you can actually get the multiple that you're looking for and have the retirement that you hope. Well, here's the problem. That problem, it's draining them. So if we can't get them back in there, we've got a challenge here. But if we can get them excited about addressing this so that they can get the multiple they're looking for, Now they get back into the business, they hustle, they have that skill that they can go in and fix whatever's broken. They get that energy again to say, okay, now I'm going to make this worthwhile because I've got this goal in mind of how much I'm trying to sell the company for. But what's funny is that person who came in initially saying, I'm tired, I'm exhausted, I'm frustrated, I just want to be done with this, can we sell it? When you talk to them, say a year later, and they've addressed the problems that were so challenging to them, they're actually now able to run a business that does function a lot more smoothly. It is sellable because it now has these things addressed that were kind of risks and weighing it down. And so they could sell the business, but they're like, why would I sell the business? It's working so well. I'm having the lifestyle I was hoping for anyway. At the end of the day, I've still got this goose laying golden eggs. Why would I want to get rid of the goose? So it's kind of funny, the transition of when working with the client, they're able to get revitalized to address what's going on in their business to the point that it now actually becomes that well-tuned machine that they were hoping for anyway. And they don't want to necessarily sell it as quickly as they wanted to a year earlier when they were frustrated. Have you ever experienced something like that?
Absolutely. So I completely agree with what you just described, and that was great advice to your client, right? It's, you know, look at the, so it really is a compartmentalization. Look at the things, and this is where accountants and bookkeepers can really be helpful, more so, than just looking in the rearview mirror. Is, let's look at your client base, this is from the client's perspective. Let's look
Mhm.
at your customers. Which are the ones that are really profitable, and what are the areas of your business that you're just better than anybody else in? And let's focus on those things, because that's what you enjoy, probably because you're really good at it.
Mhm.
So it's doing this further analysis than just overall P&L. Here's last month. Um, the value that you can provide to that client is, working with them, of saying, these are the segments that are really killing it for you, and here are the ones that aren't. So, you know I like to talk about it, and I, I had personal experience with it. There are clients who are just a drain on you. They're the ones that are always complaining. They're the ones that are paying the least, and they're just a drain on the firm. And part of the potential solution might be, we're firing you as a client.
Yeah.
And is that a revenue hit? Probably. But do you are you less stressed? Can you focus more on now the clients that you can really help? So that's one of the pieces that I help clients with, is walking through that. Let's really understand what drives your business.
Wonderful. I love it. If you're looking to advance your career in accounting, you need to enroll now in the Job Placement Assistance Program. This course is created for accounting professionals to find a new job, apply for a promotion, or get a better position within a company. It is a turnkey process to actually help you better interview, get the job you deserve, and get paid what you're worth. For more information on how you can take advantage of this offer, go to the episode description. Enroll now in the Job Placement Assistance Program. Do it for free and act now. So I'm going to ask, what's a question that you thought I'd ask that I haven't?
Uh, let's see. Maybe something around, uh, what are the different exit options?
Oh, that is true. Yeah. Tell us what those three options typically are.
Yeah. So what's scary is that over half of the businesses in the country don't even understand what their options are. So I'm gonna
Correct.
move anybody who's in that 60% into the 40% category now. The big ones are transitioning to a family member, so a family succession. And I'll just really quickly, some pros and cons. The pros are, maintains the legacy, keeps it in the family. The cons are, for the owner, you typically don't get a lot of cash up front, right? Family members typically don't pay you out like you would like, right? So definitely transitioning to a family member. There can also be some family tensions, right?
Yeah.
The second one is selling to employees or management or partners, that kind of thing. That can be a little bit better, right? You can get the employees who have been there. They know this isn't going to be a shock to the system. But again, the pitfalls are, a lot of times that management group isn't going to be able to make a big cash payment. So you're going to have to earn it out over time. and you can be a little bit beholden based on ESOPs, for example, of being in some tough cash situations as the owner who's exiting, right?
Yep.
And then the third big option is selling to a third party. So this could be just a individual, it could be a PE firm, it could be any range. And the benefits there is typically they're going to pay the highest price and definitely have more all cash options, maybe some earnouts, but typically much higher up price and much higher up front. The pitfalls are, your legacy then is at risk, right? They own the company, they run it the way they want, and that may not be great for you or your legacy, right? And then the fourth one is just to shut it down, which I'm hoping isn't a great option. But so those are the top three, along with some pros and cons.
I appreciate you addressing those, and I'm glad we had those in here because those are common questions that I discuss with my clients of, okay, let's talk about the exit strategy. We're going to reverse engineer your retirement. We're going to come up with a number. What is it that you feel you need to meet your current lifestyle and sustain it? And so that's great on a financial point of view as to here's what the organization needs to look like and be to be worth that much. So that's part of the exit strategy. But now to whom are we going to sell it? And so you're right. Inside, you can definitely sell it to the employees, and with an ESOP, take advantage of the equity that exists in the business with the knowledge of how to run the company. They already clearly are doing what needs to be done. Would they be interested in having equity in the business now? And you're selling that to them and buying yourself out. And that's great, but you're right. Typically, it's a slow transition. It doesn't typically result in that financial gain. And one of the risks that you have is, that employee might be a great manager or something, but who's to say they're a great business owner and great leader? So you may forego that great exit simply because 5 years from now, the business won't be able to pay you out what it could 5 years earlier because it's not been led well. So you've got that. You've got family. Well, just because you're a great person doesn't mean your family has that same drive and vision of where the company needs to go. So there's that option there, but it clearly can sustain your legacy. Both of those two options, you can go get small business loans and so forth that can afford a buyout and give you the exit that you're looking for. But that third one that you had mentioned, yes, there is private equity out there. There are third parties that may want to come in and geographically get a footprint where you're currently located or the niche that you're currently in. They want to use you as a way to get a leg up in that market space. And so they're willing to pay for that. But you are at risk losing that legacy. They may get rid of some of the employees. They may change some of the processes. And so you've got to be willing to let go of some of the things that you created because it's no longer yours and it's theirs to do with as they may. So yeah, there's great advice in each of those things that you just shared. So thank you for that. And fourth, that's not an option. Let's not build something, put all this energy and effort in it just to, shut it down. I hate going through small old communities and seeing basically decrepit, deteriorating houses. Somebody lived there. Somebody built that. Somebody put sweat equity into that and then just walked away from a home that clearly served a need for a period of time, but nobody was willing to buy it. And they just walked away. And I just can't imagine the anxiety of just walking away from a house. That just amazes me, but it's very akin to a business as well. So great end to our conversation today. So here's what I'm going to do. I'm going to wrap this up and I'm going to come back to you for a closing thought, Len. And as I wrap this up, I want to point out to our listeners in the episode description, there happens to be a free offer here, one that I would encourage you to take advantage of. Basically, it is a free tool that he's offering. It's a business valuation calculator. I think it's something that not only you should consider using for your own business, but more importantly, you ought to consider this as it relates to your clients to actually help figure out what it is that you're doing with them as it relates to their business. So definitely consider taking advantage of this opportunity. Go to the episode description and there find the information you need for this business valuation calculator that Len's making available to us. In addition to that, I'd like to point out two things that I believe that are going to be of value to you. One is becoming a profit and growth expert. This is a program designed to actually help you move into the CFO and advisory space where you can more intelligently address the needs as they relate to that of exit planning. It's where you can actually, as you work with your clients, help them plan for the future and address these current things so that when it comes time, they are prepared and have the books in order and have built an organization that they can be proud of. Why? Because you've actually, as an accounting professional, helped them prepare for that exit strategy. So consider becoming a profit and growth expert. Likewise, I also encourage you to go get your business score. Business score is a great thing that you can do that actually identifies within your organization the strengths and the areas of opportunity or improvement that can take place to actually increase the valuation of your business. The business score is a great way to actually just do a SWOT analysis of your company, and more importantly, give you the feedback that you're looking for as to what's going well, what are you doing right in the organization that actually lends to the valuation of your company, and also at the same time, what are some of those things that need your attention that you can actually do to increase your EBITDA and so forth. So definitely go get your business score and take advantage of that opportunity. It also is free. So as a summary, here's a few things that I'd like to talk about. Clearly, Len has the background and experience that we would expect from someone working as a business coach. That's great. He was able to take that corporate experience and now take it to the business world as a coach. And the story that he shared at the very beginning is very true and real. So often I work with clients as well that they don't plan for these things to happen. And like that lovely woman, her spouse passes away. Here she is 72 and is having sleepless nights wondering what she's going to do about her business. Clearly, once you can get that clarity as to what your preferred exit is, you're going to be able to work your business towards that direction. It's a light that you can work towards and, more importantly, benefit from. So I appreciated that story. The other thing that I thought was very helpful is we were talking about how, as an accounting professional, we can impact not only those clients that we service as preparing them to exit, but more importantly, we can also work on our own companies. And I mentioned avoid being the story of the cobbler, where the cobbler's sons or children don't have shoes. Well, let's hope that as accounting firms, we're actually doing our own books and we have our finances in order. And I hope that's the case for all of my listeners. So with regards to accounting, we want to actually have great books. It's good. It's important to have timely and accurate numbers so that we can actually help with the valuation when that day and time comes. The other thing there that were shared were the 5 things that typically are the, let's say, the reasons to not create an exit strategy. And I think whatever of those reasons, we just need to recognize that any reason to not come up with an exit strategy is an excuse to fail. And one of those things that we want to do here, whether it's our own business or that of our clients, is begin with the end in mind and reverse engineer what we're trying to actually accomplish. And so I really appreciated that part of the conversation. As it related to the valuation of the business, he indicated that only a fifth, 20% of it is attributed to what is seen. So we had a great conversation about some of those unseen things that really make up the valuation of the business, the culture, the thing that makes up the business being the standard operating procedures, the client base. All of these things, when done right, can actually increase the valuation of the business. We talked about strategies and how EBITDA actually plays into that, knowing what EBITDA is and how we can do add backs in to actually increase the valuation of our business. Lots of great little tidbits of information today that I was very grateful for. And to end, I'm hoping that we can all avoid that last story where we as a business owner keep everything so close to our vest that at the end of the day, heaven forbid an accident happens or something takes place, our family is scrambling to try and open up this treasure chest and find that there's perhaps nothing in it or something of little value. Hopefully we're building something here that is a goose that's laying golden eggs that we can be proud of, and we're happy to share with others so that when it comes time for us to step away, they can clearly go on feeding that goose and it can continue to lay those golden eggs. So all that being said, Len, what do you have as a closing thought?
Well, I think you've hit on some really great points. That is, even if you're years away from transitioning out of your business or your clients are years away, you need to start now and think about the end. And then it's really then easier to say, what do I need to do today, tomorrow, next year to get to that end? So think about it now. It's time well spent and effort well spent.
Beautifully said. Well, I appreciate that. And I enjoyed our conversation today. I thought we really addressed a number of timely topics and, most importantly, helped our accounting professionals understand how this applies to their clients and themselves and their business. So for my listeners, I want to encourage you, if you haven't already, subscribe to the podcast. Love to have you actually listening each and every week as we have experts on the show to address various things that you need to consider as you're running your companies. And most importantly, those things that you need to be doing to build the premier accounting firm in your area. In addition to your subscription, I want to also invite you to check out the highlights that we've compiled. These are of the 300 plus episodes that we've recorded, some of those that have stood out in my mind. So I invite you to go to universalaccounting.com and there find the podcast section where the highlights are gathered. These are playlists that you can go binge listen based on the current needs that you're experiencing, whether it's growing your business and addressing marketing, selling, pricing type situations that you're needing to consider. Maybe it's related to the accounting services that you're offering and you want to consider how it is that you can actually better service your clients and get paid what you're worth. Perhaps it's addressing the production side of your company where it's efficiency and workflows and staffing and training. All those things are obviously appropriate to consider as it addresses what you're doing behind the scenes to best service your client. Binge listen these, go into them, and actually find out what you need to do to work on your business and build a premier accounting firm in your area. Likewise, I invite you to check out things that we've got in there that are basically mental health type topics that I'm sure you would appreciate as well as you're trying to actually run your business and stay top of your game. Now, with that all being said, I also want to invite you to GrowCon. GrowCon is an annual conference for owners of bookkeeping, accounting, and tax businesses. It's an event that I'd like to invite you to. It's a conference where we get together with the experts, have them present from the stage various things that we need to work on as it relates to growing our business and getting our clients, whether it be niche marketing, pricing, basically everything related to marketing and sales. We also have experts that come on and talk about how we can better service our clients and get paid what we're worth providing quality accounting services. And then also we address the things related to the back office, the tech stacks that we're using, the staff training that we're providing. It's the onboarding processes and client relationships strategies that we can use to retain the clients and ultimately build the organization that we can be proud of, the premier accounting firm in your area. So I invite you to come, register, actually join us for GrowCon. In addition, it's there that you're going to meet your peers, build some friendships, and also meet the team here at Universal Accounting Center. They're committed to your success. So all those things being the case, get your ticket now. Join us for GrowCon. Lastly, I want to point out with regards to the show here, if you have any questions regarding the things that we've discussed, anything that you would like to discuss regarding growing your business, building the premier accounting firm, go to universalaccountingschool.com or give us a phone call. You can reach us at 801-265-3777. And always remember this, if it's about accounting, it is universal. Take care, have a great day, and be safe out there.